Hey guys, and welcome back to the channel. Recently I was asked in one of the comments to shed some light on why I am avoiding the stock market, or ETFs to be specific. And yeah, they were wondering if there were any other reasons besides wanting to beat the market. So I thought I'd talk a little bit about that today. And yeah, I think I can give you a decent overview of what you should look for in any stock, like from a very basic perspective. And when I say stock, I actually mean any investment, but we'll get to that in a bit. First, I think most people will think about stock market, ETFs, indexes, and if you are investing, you probably have heard of it, and then you know that if you are invested in the S&P 500, the expected return is about 10% per year if you look at the past 20-30 years. And if you go for an all-world fund, it's going to be about 7% per year. But obviously, if you have seen very good years recently, then the expected returns for the upcoming 10 years tend to lower down a bit. So this article was from November, but it contained two particular parts. And that was Vanguard last May issued 10-year forecast for US equity returns of 4 to 6% annually, and US aggregate bonds returns 2.5 to 4.5% a year. And that was last May. And this month, which is November, Vanguard issued slightly lower forecast for stocks to 3.5 to 5.5 annually, and bonds to 2% to 4% a year over the next decade. Keep in mind, this is focused on US equity. So where normally you could expect, well, depending on what asset class you're looking at, let's say for the S&P 500, about 10%. Right now, the expected return is between 3.5 to 5.5%. So that is something to keep in mind when you're about to invest in the stock market or in the ETF in a certain asset class in the US. Then I went to the website of Vanguard to look for these results, and our 10-year annualized nominal return projections as of June 30th, 2020 are shown below. Well, and here you can see US equities like 3.9 to 5.9, and keep in mind it was in June, at the end of June. US value 5 to 7%, so you can see that the expected return on value stocks is a little bit higher right now. US growth very low. That would insinuate that they are quite expensive right now, of course. Large cap, small cap, and then you have global equities without US and unhedged. It will be 7.4 and 9.4%, which would insinuate that looking across the border, at least for the US citizens, could be beneficial for them as an investment if you look at these return projections. So this is obviously if you invest in the stock market, and if you are susceptible to recency bias, you might think, well, we have seen 2019 29-31% return on the stock market, it's going to be great years, momentum, let's do this. But if you take a longer term look, then it might actually be a very bad position to be in the stock market right now. Regardless, while all these projections are there, I still believe that for most investors it is probably best to invest in an ETF, in a broader ETF portfolio, an index or whatnot. And why? Because, well, I think most people tend to be investing in the US growth stocks. People get excited about it. It's thrilling, it's hyped, and yeah, we could see a drop, and I believe that people could see a drop that they haven't seen in the past 20 years on at least some stocks. So I think people should be a little bit more careful, and yeah, I think for the most, I guess for the average investor, I should say, it's probably best to stick at least partially to an index fund. But in my opinion, any investment has two main aspects. And the first aspect is a story. And with a story, it can be very broad, but any investment has a story. So whether you think about Tesla, NIO, those are companies that have pretty good stories, and that is why they are so attractive right now. But you can also think about all these ESG stocks, like the battery storage, all that. Every investment has a story, and some are more obvious than others. And the second aspect of any investment is they have an expected return, and that is the valuation, what I like to call valuation. So for me personally, I tend to lean to the expected return slash valuation and less on the story. But I am slowly realizing that the combination of two is absolutely necessary for both. And what we have seen over the past few years, I guess, is well, I guess if even longer than that, I could say a few decades, is that growth stocks prefer stories and value stocks prefer valuation. And obviously, the latter is pretty obvious. But when you think about growth stocks, people tend to say uh, they tell you the story about the investment, and it could reach the point where they say, well, it doesn't matter what the price you pay because it's a growth stock and stuff like that. Like, I'm not going to go into many examples, but I think you can all think of situations where these are included. Growth stocks also tend to be the stocks that haven't produced anything yet and are just basically being traded or sold based on the CEO stories, which is the literal story. And value stocks, well, they prefer valuation in the sense that, okay, you look at the numbers and then you see, well, this company is undervalued. And with undervaluation, I don't mean, okay, price to book value or something like that, but I'm more talking about the cash flows or the expected cash flows in the near future. And that's the upcoming 10 years. And what what I realize is that both, while growth stocks have a preference towards stories and value stocks have a preference towards expected return slash valuation, I think any investment needs to have the combination of the two. If you just invest in a growth stock without thinking about the valuation, it is bound to fail at some point. You just don't know where. And if you sell along the lines upwards, then you are probably protecting yourself properly. But still, it's quite risky as an investment. And value stocks, if you only look at the valuation and not at any story, then you have basically no idea of when the company is going to turn it around. So you need to combine the two. And yeah, I think that is very important. And that's not something people realize a lot. As I mentioned, any investment has a story. So when you invest in an index fund, in this case I call it the stock market, then it has a story. And like, I'm not gonna lie, the story is very long. And if you want to know the story, you can go to any index preacher or any research paper, I guess, that will confirm this. But the general gist of it is that it goes up long term through economic growth, and we can expect economic growth because we have seen that the past few hundred years. And it also protects you against inflation. And a bonus, it pays a dividend along the way. That's the story of the stock market. So the valuation is economic growth, about 3% per year. Inflation, it's inflation hedge, I should say, is about 2%, and then dividend yield could be, depending on what price you pay, about 2% in the long run. So the expected return is about 7% per year. So the stock market or an index fund, and then I'm talking about the all world index fund, it has a very clear story, and the valuation is very clear in that regard as well. Some stories are easier, some stories are difficult. I think if you are stock picking, the story you're telling and the story that is being told are two different things, and valuation can be very tricky as well. But the basics always stay the same. And to get through some of the basics, I'm gonna just give a simple example that many people have shown before, and that's a lemonade stand. So I think going through the basics or to the basics for any investment, you want to look at it like a lemonade stand. What do I mean with that? Well, you have a simple story. Don't make it too difficult. Thirsty customers who are willing to buy lemonade while they're out on the streets. It could be a simple story like that. I'm pretty sure that most people who have a lemonade stand will come up with a better story than this, but it can be a pretty simple story. This is clear. There's no weird expectations there, and yeah, that's basically it, right? The valuation could be, obviously this is just an example, it's an investment of 1,000 euros. The expected profits is 100 euros per year, after all the costs of course, and then you have an expected return of 10% per year. That would be the valuation. With any investment, this is basically the valuation. This is something you look at, and you know, when you look at stocks, I tend to look at free cash flow for the expected profits, I'd say, and I would calculate my expected return based off of that. But the same goes for any real estate investment, the same even if you just buy a garage or something like that, and you start to rent it out somewhat. Same thesis. You have an investment, you have expected returns, and you probably have a terminal value as well. In this case, you could say, well, at the end of my 10 years, I could sell my lemonade stand for about 250 euros, so that could actually add to your expected return. But those two things are the most important things of any investment. And if you just realize these two aspects, I think you can make a big difference, because the moment you distinguish this, you realize, okay, that for people that are very into value stocks, you might question their story. And for people who are very much into growth stocks, you might question their valuation and look at that. And as I said before, I think you should combine the two to come up with a good investment thesis. So to sum up in that regard, reasons to avoid the market, it could very well be the case that the story does not align with you, or the expected return / valuation does not align with you. So the moment it's the latter, I think you are trying to beat the market, which I think personally is fair. Like, I do not go to through life thinking I'm average, so I think people who think that they can expect to beat the market, I think that it's worth a shot at least, right? And if the expected return for the next 10 years is 3.5 to 5.5%, it may not be as hard as you initially think. And yeah, the first one would be the story does not align with you. So in what way could the story not align with you? Well, you can just make it as crazy as you want. In that regard, you could think that, yeah, I do not think the economy overall in the world is going to grow. I think we're going to switch from an economic growth to a more social growth perspective or something like that. Like, you could make it as crazy as you want, and the story could just not simply align with you, and that could be a reason for you to avoid the market. For me personally, and that's the question that I got asked, like, I have several reasons why I avoid the market and why I avoid these research papers that we have seen, and I've made a Dutch post about it on Reddit once, but I'll make a video about it in the future. But in this particular case, on these two aspects, I would say that I avoid the market, even though the story is great. Like, for anyone who doesn't like investing in an ETF for an all-world index fund is probably an amazing solution. And yeah, it's hard to go wrong with that if you're a long-term investor. But the problem I have with it, mostly with the story, is that it doesn't contain the traditional investment hypotheses. So I do not look at the stock market and think, okay, well, this is going to generate me the future cash flow, so this is going to generate me a certain profit. So in that regard, I don't really like that story. And while that is a little bit intertwined with expected return, it is mostly the way the return is calculated that simply does not align with me. And well, you guys know what kind of returns I'm aiming for, and I think it is achievable. And even if I miss it half, I would still able to beat the market. So I think aim high, achieve high in this case, basically. But the expected return is lower than what I aim for. That's just the way to simply put it. So that is why I avoid the stock market. This same apply to avoid stock picks or stock picking. Maybe the story does not align with you. It could be from a fundamental perspective in general, that you just don't like the way investment thesis works. But it could also be that particular stocks that you don't really like from the story or from the valuation point of view. So while I think I could say that the reasons why I avoid the stock market is the same reason why I avoid many stocks, for sure. And in this case, I think I would avoid 95% plus of the stocks out there. So yeah, you see me with a portfolio of about 10 to 15 stocks on average. And yeah, I think it's safe to say that I've looked over 300 stocks. So I think many more actually. But yeah, so I could say that I avoid many stocks for the same reason I avoid the stock market. Just because all of this is my opinion, I want to make sure that you don't forget the following. That on average, individual investors do not beat the stock market. So from that perspective, it is likely that you will not beat the market. And sure, like, we can twist about the top 10% that actually do beat the market by a mile, but yeah, people will say that those are lucky and whatnot. But yeah, from an average perspective, it is unlikely, or it is likely, that you will not beat the market. Second point is, you need to remember that every investment has a story and a valuation, and there's going to be times where people will tell you the story doesn't matter, or the story matters so the valuation doesn't matter, and the story doesn't matter because the valuation is so low, so that's why you should invest in it. And then you see the stock even drop further. Then you think, how is this possible? You're trading at a price of one free cash flow, basically. So you'd have your investment back in 1 year. How is this possible? Yeah, and then it goes bankrupt or whatnot. So every investment has a story and a valuation. And in my opinion, and that's the last point, story and valuation should never be separated. And yes, I mentioned before, I lean a lot towards valuation, but I'm slowly realizing that, yeah, I can find a cheap stock, but if I don't have a story behind it on why it's going to turn around, then it's probably not a good investment. And yeah, for me, it's going to be very hard to invest based on just a story, but that's not what I'm aiming for here. I'm aiming for a story, and based on that story, there will be a valuation as well. For example, it doesn't mean that if you have a good growth story that you're not going to have a good valuation. You could just implement the growth percentages in your valuation, and that will tell you whether your story is going to be, or likely going to be, a good investment, or the whole investment is going to be a good one. So it doesn't mean that just because you're a growth investor, just because you're a value investor, these two things, story and valuation, they go together. Do not separate them, and keep them always in mind with whatever decision you make. Make sure that your cheap stocks have a story, and make sure that your growth stocks have a valuation. Thank you guys for watching. Hope you found it valuable. If you would like to see more videos like this, in the sense that, okay, I'll tell you more about why I avoid stock market, let me know down in the comments below. Besides that, it would also be very helpful for me if you tell me why you are stock picking, because yeah, I'm very curious about that. Thank you guys for watching, and see you guys tomorrow.